Retirees, this is a warning you can't afford to ignore. What came out of Jackson Hole last week is being celebrated on Wall Street. But if you're retired or planning on retiring, what the Fed announced could be a kill shot to your savings. And here's why. Before we begin, remember to like this video and subscribe for more economic updates. Markets are on a sugar high. But history shows what feels good today can devastate your income, your savings, and even the strength of the dollar tomorrow. Federal Reserve Chair Jerome Powell indicated that rate cuts are on the way, with markets pricing in an 85% chance of a September cut, with more to follow by the end of the year. On paper, this sounds like good news. Lower rates boost stocks, make loans cheaper, and give the economy a sugar rush. But other countries that have tried to prop up growth with artificially low rates like Turkey, Argentina, and Venezuela have ended up in the same trap: a weaker currency, higher inflation, and shrinking purchasing power for ordinary people. Here's what this means in real terms. Your income after inflation, meaning your real yield, is collapsing. Picture this. If you have $500,000 in CDs earning 4%, that's $20,000 a year. But with inflation at 3%, your real gain is just $5,000. Now imagine the Fed cuts interest rates to 3.25%. Suddenly your income falls again, and to keep up with rising costs like groceries, utilities, and healthcare, you're forced to start dipping into your principal. Every withdrawal shrinks your base, so each year your income shrinks further and further. Given the circumstances, it's no wonder why most Americans say they fear running out of money more than death itself. If that wasn't enough, here's where the real danger builds. Politically driven rate cuts might seem sweet at first, but can erode trust in the dollar itself. When a government chooses short-term growth over long-term stability, the currency pays the price. We've seen this play out. In Turkey, a decade of easy money cut the value of the lira by more than 80%. In Argentina, consumer prices shot up 237% in 2024. And in Venezuela, hyperinflation reached 130,000% in 2018, and people were fighting over food. The U.S. isn't immune. The dollar has been strong for decades because the Fed prioritized inflation control over politics. If that discipline is abandoned, the strength of the dollar and your purchasing power can erode just like it did there. And history proves it. In the late 1970s, runaway inflation gutted the dollar and crushed retirees living on fixed income. It took Fed Chair Paul Volcker in the early 1980s to do what politicians wouldn't. He raised interest rates aggressively to break inflation. Former Fed Chair Volcker, having the discipline to raise interest rates, saved the dollar and restored purchasing power for savers. Today, the Fed is walking away from that discipline. When the Fed lowers interest rates, retirees pay the highest price because fixed incomes don't adjust. Your Social Security check, it buys less every year. Your savings, it earns less while costs rise faster. Your retirement plan, it becomes a shrinking target you can't hit. That's the cost of political convenience. Regardless of what happens with interest rates, here's the part that most people don't see. Even if policy changed tomorrow, we're facing forces that could make the problem much, much worse. By 2034, older adults will outnumber children for the first time in U.S. history. That shift means more savers pulling out of risk assets and moving into cash and bonds. At the same time, keeping up with demand globally for transportation, power, water, and telecommunications could cost more than $3 trillion each year money that simply hasn't been there up to now. Translation: money gets more expensive, inflation stays sticky, and rate cuts just pour gasoline on the fire. There is one market that already understands what's happening: gold. Gold surged 1.1% immediately after Powell's Jackson Hole speech, hitting $3,373 an ounce. Why? Because gold historically strengthens when real yields collapse, trust in the dollar weakens, and global capital looks for safety. Unlike paper assets, gold has no counterparty risk and no yield to erode. That's why central banks are buying gold at a record pace. Don't confuse the initial rush from rate cuts with real strength. Like any sugar high, a crash usually follows. In this case, the long-term effects are clear: shrinking income, rising cost, and fading purchasing power. At this point, can retirees really afford to rely on the Fed? Or is it wiser for them to rely on assets beyond the Fed's control?
Sign up for your one-on-one web conference with Augusta Precious Metals today. No commissions, no pressure, just education. Click the link in the description to learn more.